Welcome back to Tipping Point. I'm your host, Kara McKinney. The official GOP account on X is retweeting a chart that is simply labeled Bidenomics. It compares and contrasts fast food prices across 5 different menu items at 3 separate chains: McDonald's, Taco Bell, and Chick-fil-A, from where they were at the end of 2019 to where they are now in mid-2024. The average price increase is about 80% across the board. A Big Mac, for example, used to cost just under $4 according to this chart, and now it's closer to $8. A large milkshake from Chick-fil-A used to cost about $3, but now it'll set you back a little over $5. While individual prices may vary on state and franchise location, the overall picture this paints is true enough. Even fast food is no longer cheap, nor is it fast. Now, this isn't a problem that can be solely chalked up to Biden inflation, as fast food prices have been steadily increasing since about 2014 for a myriad of reasons, not least of which is because inflation has been eating away at American consumer power for decades now in cycles. Our pennies aren't even worth the metal they're minted on, for crying out loud. You can thank the Federal Reserve for that and for so much else. But while all of this is true, the situation really accelerated under Biden with all the immense government spending we've seen. Even though Biden's latest fixation has been to say that inflation was at 9% when he took office, and so he's actually the one responsible for bringing it way down. But actually, it was under 2% when he took office and rose to 9% under him. And plus, cutting the rate of inflation doesn't cut the damage already done by inflation. It's cumulative. So prices aren't down across the board necessarily. They just are increasing as fast, which is not much of a victory if you ask me. Americans are feeling the squeeze every which way they look. The feds definitely want to lower interest rates, especially before the election, but inflation has proven too tricky, and so that dream promised to us last year is getting more distant from us. I understand that with too many dollars floating around that the feds need to take some out, hence the raising of rates, but it always seems like DC gets to spend us into oblivion and then demand that we be the ones to tighten our wallets by gritting and baring our teeth through periods of high interest rates and inflation. Why don't they ever bite the bullet and make some cuts? Why does it always have to be us? Though, of course, we already have the answer to that, as laid out by Thucydides, the 5th century BC Athenian historian and general, who once wrote, "The strong do what they can and the weak suffer what they must." Our next guest tonight has likewise given some thought to this predicament we find ourselves in, writing this article for USA Today. It says, quote, "Can I get a car loan? High rates, regulatory uncertainty hurt Americans' ability to borrow." At a time when the Biden administration and many economists insist that the U.S. economy is doing well, why do many Americans have so much concern? Blame high interest rates and tight credit, end quote. Joining us now to discuss is the author of this piece, Bill Himpler, the president and CEO of the American Financial Services Association. Bill, thanks for being here tonight.
Kara, it's my pleasure to be with you.
Great. So talk to us about this disparity that you note between how the economy is being presented to us in the media and by the White House essentially is booming, they say without exactly saying that phrase, while Americans, though, as you note, are really struggling and hurting right now.
Oh, well, I'm not sure I'm going to be as good as Thucydides, but I'll try. You are getting a lot of hot air and happy talk out of Washington these days. The administration trying to peddle Bidenomics, and nobody is buying it because they see this, whether it's at the pump, at the grocery store, as you laid out, at the fast food chains around the country, although I'm not allowed to go into those as many times as I used to be able to. But folks are really feeling it. They're feeling it with everyday consumption prices. They're feeling it with trying to get their piece of the American dream, getting a mortgage on their first home. It's just not there. And a lot of it has to do with all of the money that you said was pumped into the economy, driving up inflation, and it's sticky. The Fed would like to act, but they can't because we're still in an inflationary environment. But you add to that the Consumer Financial Protection Bureau, which was designed back in 2010 to protect the consumer, and there's a role for that, but they've created an environment where there's no rules of the road. And so my member companies, be they, installment lenders, vehicle finance companies, mortgage or credit cards, don't know what the rules of the road are, and as a result, they tend to kind of pull back. And this is not a time for those that need access to credit to make ends meet. And so we're hoping to get a change out of the administration in record time.
So it seems those who are trying to refinance right now or to take out loans, like you said, are kind of stuck between a rock and a hard place because on the one hand, because of inflation pushing many people to need loans in this environment, you get hit with the high interest rates. But then, like you also are saying, the Consumer Financial Protection Bureau is also making it more unlikely that lenders will in fact lend to them. So when you talk about the Bureau and you talk about that there's not exactly a road or a road map and a lot of lenders have to pull back because of this uncertainty, can you explain to the audience in more detail exactly what you mean by that?
Well, probably the best way for me to describe it, because a lot of us drive cars every day to and from work to pick up kids at school or run basic errands. It's kind of like being pulled over by the sheriff for speeding and there's no speed limit sign posted. You have no idea whether or not you're driving within the law or not. It's the same thing when you create a regulatory environment or don't have one, so that what you issue are press releases and blogs and statements. Companies have to actually read the tea leaves and guess what the Bureau is trying to say. And in the financial services sector, companies tend to be a little more on the conservative side. They don't want to be overly exposed. So in terms of being precautious, without any guidance from the federal government, they tend to pull back. And so that means folks that are struggling are not going to get access to safe and affordable forms of credit.
And a lot of Americans right now, because they are feeling this and they need that help, they need, this weight off their shoulders. So many now, as the polls show too, are living off of credit. And as you talk about in your article, you say here that credit companies said they saw deteriorating consumer credit conditions in the first quarter of this year of 2024. So can you explain for us just how bad it is when it comes to a lot of the credit that, we Americans are living off of right now just to make ends meet?
Well, it's a great opening, and thank you very much. Essentially, we've got, I'd say probably 8 out of 10, maybe closer to 9 out of 10 American consumers of consumer credit utilize their credit very effectively. They pay their bills on time. It's that, last 1 or 2 that don't. And if your audience takes anything away from our conversation, I hope they'll take this away. If you do get behind in your payment, reach out to your creditors. We want to work with you. We want you to succeed. It's good for everybody. It's good for the creditors. It's good for their shareholders and stakeholders. It's good for the consumer, and it's good for the economy.
No, definitely. That's sage advice to be giving right now. And when it comes to some of these debts not being paid back, then are you seeing any issues when it comes to banks or certain lenders? Because I remember last year, and of course you were the more financial minded guy here. I'm the layperson who's just asking the questions, trying to make sense of it myself as I go. But I remember earlier, I think it was last year, maybe it was actually the year before that, but we saw some regional banks close in I think California mostly. But are you seeing any fears of that in some of these perhaps smaller lenders or smaller banks?
Not seeing that in particular, and some of those failures were due to concentrations in one area or another, and really hadn't been well audited throughout the process. But I'd say most financial institutions work with their regulators. Are examined on a regular basis, be they national banks at the federal level or institutions like credit finance companies or state banks are regulated by their state regulators on a regular basis. And so, the deterioration that we're seeing is, I think, to a certain extent, normal economic cycles, as much as that's not what folks want to hear. But here again, this can be rectified by clearer direction from our regulators, such as the CFPB, and our ability to work directly with customers and find solutions, workouts. If you can only make a partial payment or you need to restructure something, like I said earlier, credit card companies, mortgage companies, vehicle finance, and installment lenders all want to work with their customers and make sure they succeed. It may take a little bit longer, but we want a successful outcome. It's good for everybody.
That it is, Bill. I really appreciate your analysis and your expertise. Thanks so much for joining us.